Great. Sound is good. Let's get going. Just bear with me, everybody. I hope everyone's well. It's been a real weird week for FX, I would say, largely because of that, how can I put it? Very difficult to read. Non-farm payrolls in the US. Just bear with me one moment. I've just got to pull up my disclaimer. One of those necessary evils, which will, not take too long to go through. Just bear with me. Great. Brilliant. So you're all up. We're all out and running. And yes, I believe that you can all see my desktop. What you should be seeing is a disclaimer. Brilliant. FX Street. Thank you for that. This webinar is provided solely as a courtesy to aid the education of our customers and prospective customers. It will discuss risk management concepts, strategies, and does not include the recommendation or endorsement of any particular security, chart pattern, or investment strategy by Forex.com. This webinar has been prepared without regard to specific investment objectives, financial situation and needs of any particular recipient, and we don't guarantee or verify the accuracy of the information or commentary provided. Futures, options on futures, foreign exchange and other leverage products, they involve substantial risk of loss and they're not suitable for all investors. Spot gold and silver contracts, they're not subject to regulation under the US Commodities Exchange Act, and contracts are different or otherwise known as CFDs. They are not available for US residents. Okay, guys, that should be that. Now, bear with me one moment. I'm just going to put up our charts, and then we're going to get going. So the first thing I want to start with, let me move that away. The first thing I really want to start with is actually the dollar. Just because we've had such an interesting run with the dollar, as you know, certainly from a fundamental perspective, you know, the dollar is very much in focus right now. There's just so much going on. Obviously, there were payrolls last week, that torrent of economic data last week. There's still Syria in the background. And then as we progress through this month, we're only a week and a bit away now from that all-important FOMC meeting. So incredibly important, incredibly worth watching very, very closely indeed. And, you know, from our perspective, a very interesting time to be trading the markets. Now, this is what the dollar did. Obviously, remember last week, we got that slightly weaker than expected payrolls reading. It was, let me get the exact number for you. It's somewhere around the region of 160. I can't believe that slipped my mind. It was, 169 actually, and the unemployment rate fell to 7.3%, but it was largely because of a massive drop in the participation rate. So, the fall in the unemployment rate isn't really great. It's not giving a very good overall picture of strength in the Aussie economy. And instead, you know, people were focusing on that non-farm payrolls number, and that explains this. Those sharp drops in the dollar, we saw it not just on Friday, it followed into yesterday. A strong recovery elsewhere, and there were a few reasons for a broader-based recovery yesterday in the G10. Number one, because the dollar had performed fairly well in the lead up to payrolls, but also because we saw some reduced tensions around Syria, and that helped push up things like the Aussie, helped push up some of the emerging market currencies, helped the euro to recover some losses, and also the pound as well. Big day for the pound tomorrow. I'll talk more about that later. But as you can see, we're kind of range bound. We're in a bit of no man's land here. We've reached a low of 81.70, which is that 200-day moving average, or the yellow line in this chart. And yet we're being thwarted a bit on the upside. 82 is making a real meal of trying to get to 82. 82.20 and then 82.35 are two other moving averages which should act as good resistance. A lot of people in the market looking at that 100-day moving average there at 82.35. It's important because obviously it's above 82, but it's not quite up there. It's kind of the resting block, if you like, before this double top here, which comes in at 82.70. Remember that was a high from last week. That was a high on Friday before that payrolls number. Is 169 good enough for them to taper? It probably is. But it's more just, how much tapering will they do? Probably not as much as some people had been expecting. This time, 2 months ago, people had expected them to taper around about that 25 billion mark. So cut back by 25 billion a month. Bring it down to maybe, 55 billion rather, or 60 billion rather than 85. Right now it looks like that could be toned down to 15 or 10, I'm even hearing. And that to me is kind of it. That's only a token gesture. That's not really tapering, is it? Obviously, that's not going to have a massive impact on the market. So that's why, that's certainly why the dollar's been kind of just range bound really. And I can see it staying range bound really into the FOMC meeting next week. Now there is some important data that you need to watch this week. We kind of have the end or the tidbits of the end of the month or the August data coming out. We've got retail sales on Friday. Then we've got the first reading of September consumer confidence, which will be important. That comes out on Friday afternoon as well. It's a shame it comes out, fairly late European time on Friday afternoon because it can kind of have a weird reaction. It'd be good if it came out a little bit earlier, but that's not to be. We also have, today, for example, we've got small business optimism at 12:30, and then as we progress through the week, we've got some PPI data. Producer prices, and also initial job list on Thursday, which will be important too. So there still is quite a lot of data to digest, so definitely worth watching. But as you can see there, the dollar index is really it's trading. It was weak yesterday on a daily basis. It seems to have found its bottom at the moment, but its upside has been very, very limited, and that's really what's colouring all of the other main G10 crosses. Let's just take a look at one of them. I want to show you euro. Remember, after the ECB, the euro fell a little, then it rose a little. As you can see here, basically from Friday, this is a reaction to payrolls. However, this blue candlestick here that I'm circling, probably a bit too fast for some of you, was the reaction to the ECB. So again, the market doesn't know how to react. The ECB weren't dovish enough to push us below 131. And likewise, payrolls probably, not strong enough to get us, back to those kind of 133 or 134 highs that we saw in the kind of this time 3 weeks ago. What we do know is that this kind of cluster of daily moving averages here at 131, 50-ish, the 40 to 50, which combines the 100-day and 200-day moving averages, they should act as fairly good support where we are now. Add to that, we've also got the 50-day moving average here. Let's just take a quick look at the Ichimoku, because we had been, threatening, or we had been below that cloud. The support here, which is the base of the cloud, that also held as well. That's 130.80. We didn't really get near there because, again, those kind of 131 levels help prop us up. So, what I'd say for the euro right now is still back within its range. Let's just go back, to the other chart. This is a daily chart. And the reason, I know some of you are much shorter term traders than that, but I think the daily chart is a good one to just look at, just to get a sense of where we are. Look at the 60-minute in a moment as well. But as you can see here, we're still very much range bound. There's some solid support there, and you do want to remember that when you're trading the euro this week, especially if some of you are a bit bearish on it because of the ECB. Remember, it's not just all about what the euro is doing right now. A weak dollar or a dollar that fails to rally or fails to recover this week could also be a key driver of euro. So looking at the daily chart can be quite important for you short-term traders out there too. I'll look at the Aussie in a minute because it's really interesting developments in the Aussie. I like the Aussie. But as you can see, this is the daily. Let's just go into the hourly. As you can see there, made a nice run for the hills above 132.50, got all the way to kind of 132.75. But since then, we've just trailed back a little bit. We've got a bearish crossover there on the hourly MACD, which suggests that we may, very short-term momentum may still be to the downside. 132 though looks like it could be good support. That was kind of that's just the key, kind of support level, channel support perhaps. But overall looking fairly mixed. Top of the range, bottom of the range. We kind of know where we are with euro, I think. Bottom of the range is that 131 level. Top of the range is that kind of just below 133. I could envisage us being stuck in that 200 pip range into that FOMC meeting. In terms of Europe, what's going to be important this week? We've got some meetings. Some speeches from some ECB members, including Draghi on Thursday. He will talk on Thursday. ECB, Asmussen is talking today at 1:30. It'd be interesting to hear what what they say. Asmussen can sometimes be a bit outspoken. Interesting to hear what they say about kind of, if you remember last Thursday, cast your mind back, I know it seems a long time now, but it was when Draghi said, we did discuss a rate cut. That's when the market, the bottom fell out of the market. That kind of coincides with this move here, which was the 5th, of course, which was that ECB meeting last Thursday. That coincided with that big move here. So that was, it would be interesting to see. Asmussen tends to be on the slightly hawkish side. So it'd be interesting to see if we get a little bit more colour about what that discussion was. Was the rate cut, was the discussion very much like, yeah, we don't want one, in which case could be euro positive, or was it a bit like, yeah, we're going to keep that option on the table, which could see us just trade back to the bottom of that range. But as I said, for now, we're low volatility in euro, we're trading in a range, and we think that low volatility in range will persist into next week. Now, that doesn't mean there aren't opportunities. As I said, towards 133 is acting as a short-term selling zone. And then there could be some buying here around 132. And if not below there, then this kind of just ahead of 131.50 could certainly cushion the downside if you're just kind of scalping and looking for a few pips here and there. Certainly nothing wrong with that strategy at all. Certainly not in this environment anyway. The other thing I wanted to show you is cable. Very, very big week for cable. Let's just take a look. Firstly, let's get an overall arching look by looking at the daily chart. As you can see here, a couple of things I want to point out to you. We're at the top of the range that goes all the way back to June. We're still above 157. That's a very bullish development. Interesting enough, the driver of the pound up here. Well, it's not really been too much. Obviously, the key driver has been the fact that the Bank of England just left rates on hold, and they didn't announce any type of, they didn't make any type of announcement. But the key driver obviously this week is going to be unemployment, and the market does expect a bit of a pickup in the unemployment rate. Now, it's interesting to know how that will impact, or how that could impact the pound, because basically if we see the unemployment rate drop, as some people in the market expect. Right now, Bloomberg is expecting it to remain at 7.8%, but there is a vocal few in the market looking for it to fall to 7.7%. That could be a very bullish development for the pound. And the reason why is that it's getting back to that 7.7% unemployment rate, which is the threshold, the Bank of England's threshold. So at 7%, they could start raising interest rates. That's what they're looking at. So obviously any drop in the unemployment rate, do look out for that. That's released 9:30 tomorrow. We are going to be writing about it on forex.com. I will be putting something out about it. In fact, I just want to give you quickly the link to our research. I know I do this. I know some of you are here every week. So do apologise for my shameless. I'll share my shameless promotion here. But just so you've got it, there you go. That's where you can get all our research from not just me. You get it globally. You get great research from the US, great research from Asia, and hopefully good research during the European session as well. Sorry, going back to the pound now. I got easily distracted, don't I? But here we go. We're testing 157 here. We're still in positive territory. It's looking not quite yet in overbought territory, so there could be further upside to go. But to really get drilled down into where we are heading from a technical level in cable, as you can see here, we got all the way up to 157.30, and then that's just attracted a little bit of profit taking, I would argue. But as you can see, pullback been very, very shallow. Now the momentum, short-term momentum does seem to be to the downside a little bit, but I would say that's more about profit taking rather than outright shorts being put on. In terms of where we could go next, obviously 157 being a very important level. As I said, dating back to those highs from June. Just bear with me while I pull another chart together. Some bullish developments. We got above the top of that weekly cloud here, and that came in at 156, so we're well above there. Cleared that level nicely. And then this is a weekly chart. So on a weekly chart, it does look like 160 is on the cards. Indeed, it may be. Now, just bear with me for one moment. I'll just go back here. As you can see, that 157.45, this is a weekly 200-week moving average. In this context, whereby we're at kind of a historical high or a multi-month high, then the weekly moving averages and weekly technical indicators do come into play. Now, some people don't like looking at the weekly. They think that they're not watched that closely, that they're not as important as the daily. But I believe it's all about context. So, for example, if we have made multi-week highs, as we have in cable, then I do look at the weeklies, because to me that's quite important. Oh, FX Rory. Oh, I'm glad to hear that you want to open a forex.com account. I'm very sad that your money is stuck elsewhere. Do call maybe one of our sales teams, and I'm sure they'll be able to help you there and help you sort out your problem. But anyway, going back to the pound, no wonder we're getting stuck here at 157.40. It is a 200-week moving average, and if we do get above there, then it does open the way to this level here, 160. Now, are we going to get above 160? Are we going to get to kind of 165, 170? These were the levels that we were trading at last year. I'm not 100% sure yet. I think it's going to depend on the economic outlook. It's going to depend on things like the minutes. It's going to depend on the minutes from the Bank of England meeting, because we don't seem to be getting statements. So that's a bit of a shame. It's a real shame that we're not getting statements from the Bank of England, because that's really what's fueling this rise higher in the pound as well. It's what's fueling that rise higher in the pound, and it is also purely because the market is then doubting the Bank of England even more. So if we heard from the Bank of England that maybe QE's on the cards, maybe even some much more aggressive forward guidance, they're going to not just use forward guidance, they're going to back that up with QE, something along those lines. If we found out that may be what's the pound. But for now, it's better economic data. Its momentum seems to be on the pound side. We've got risk appetite back, and the dollar's not doing anything. Those three things are very potent to push the pound higher. Now, as I mentioned, we do have that labour market data tomorrow. That's going to be the key fundamental driver. Stronger than expected data, again, could push a drop in the unemployment rate, for example, could push the pound higher, just above that 157.40 level, which could open the way to 158 in the very short term. Rhea, what are the other moving averages besides 200? The 200 moving average. So the ones I look at, so here we have a red is 200, as we said. 100 is the yellow, and 50 is the bright green. And the reason why I look at them, they're not just randomly chosen numbers. They are just the most important ones. Other important ones are 21 and 9. I sometimes look at 21 and 9 day moving averages. They can be very important, especially for the kind of real short-term trading. But I've just got these three on there right now because they are important. So is sterling still in buy territory, you say, FX Rory? Well, I would say, whether or not you buy, that depends on your outcome, on your trading view and your time frames and your account and everything else. But I would say momentum is to the upside still. We don't seem to be in overbought territory yet. We're not far away from it. But the fact that we're now getting ahead of this level, I think a lot of people will probably sell around that 157.40 level. There could be a bit of stickiness around there. We could pull back. Any move towards 156.80 or 156.80 to 156.5 could attract some more buying interest there. That would be my view. I think people will fade the down move. I think people will be reluctant to get into the pound at 157.40, and I think any down move, especially ahead of that. Apologies there. I just had to sneeze. Any move any kind of 50 pip drop, say, could be used as an opportunity for the pound, especially if people are expecting some good economic data tomorrow. I'm using SMAs, Ty, because I find that SMAs are used very widely in the markets. Exponential moving averages are too, and you can look at both. But I do think that the simple moving average is more prevalent in the market, and that's why I use it. And the reason why is because, for me, technical analysis is really understanding what the crowd is thinking. And if the crowd, and the best way to do that is to look at the indicators that most people are looking at. So your 200, 100 day, 50 day moving average is key. I know, as I said before, some people think that the weekly is too far ahead, but I do think that the weekly, it depends on the context. And in something like the pound, where at multi-week highs or multi-month highs, then the weeklies do come into play and people will be looking at them. So that's why I look at them. Okay, I want to show you the Aussie now. Two charts on the Aussie I want to show you. Nice recovery. Nice recovery, isn't it? We fell down to kind of just below 92.5. I believe that would be a buying level. And we could get back to this 94.40 level. But there is a big stumbling block on the way. And I want to show you that here. A big resistance level coming up. Just push this over here. This top of the daily Ichimoku cloud, which comes in at 93.20. Ahead of 93, we have run into a little bit of stickiness, a little bit of taking profit, but we are, we still look good in my view. That's a really nice uptrend, and what defines an uptrend is a series of higher lows, and we're still in there. So we are still, we still look good for 93.20, but I would imagine that, we could, any move like we saw today, we saw a move back to 93.5 or just below there. That was picked up. So any pullbacks have been quite shallow. The Aussie, what's important, what's driving the Aussie? I want to show you this as well. Bear with me. I may need to change this. No, I don't. I want to show you this. What is this? I hear you ask. The orange line is the Shanghai index, Shanghai composite index, so the Chinese stock market. And the white line is the Aussie. And unsurprisingly, they're both moving higher together. So as you can see from kind of, particularly from kind of May, April this year, around about this level, they really plunged together, and now they're just trading back together. And why that's important and why I looked at that today is that we've had a better run or a real recovery in Chinese economic data of late, and that's helped push the Aussie higher. So the Aussie, China has been one of the pillars of the Australian economy for a good few years now. It was doing quite badly. Oh, apologies for that. It was doing quite badly, and that really weighed on the Aussie earlier this year as we saw kind of China data disappoint. We saw kind of some fears that China wouldn't, was bound to slow. Now, China is going to slow, but I think the fact that, we've seen economic data look like it's made a bottom, that's given the stock market, which again, remember, everyone stock market investors, they look kind of out down the line. So they're saying in 6 months' time, we think China's going to be in a much better position. That's pushing up the Shanghai Stock Exchange. And then that better forward outlook for China is also helping to boost the Aussie. So what to take away from that? Good economic data in China is probably good for the Aussie. In our view, there could be, this is quite a small recovery compared to how far before it fell. Remember, we were close to 106 back in April. In our view, Q4, one of the biggest surprises in Q4 could actually be a bit of a recovery could actually be a recovery in the Aussie. That probably wouldn't be expected, but it could certainly be, the thing that we watch out, that people watch out for. And could also be one of the themes. Obviously, it will depend on China. It will depend on the RBA. But another way that China's economic data impacts the Aussie is because the RBA, so this is the Central Bank of Australia, is very sensitive to external developments because it's so reliant on commodity exports. And in that sense, what it tends to mean is that if China's recovering, it might make the RBA a bit less likely to hike interest rates anytime soon, or to cut interest rates, anytime soon. Okay, everyone. I am happy to take a couple of questions, actually. We've got about 5 minutes. I want to look at gold. Sorry, I know there's a good few of you who like to look at gold. FX Roy, you're saying euro dollar keep lower and probably will bring GBP USD too. I mean, it depends on the dollar. I think, what we saw with Friday's payrolls is that, the dollar is being very much driven, pretty much, a big impact or a big pillar of support for the dollar is tapering, and we will hear more about that next week. So I think it depends on that. Until then, I can see us potentially trading higher. Obviously, we are close to that 157 level in cable. That could limit gains, but I think it will depend on, how strong the UK economic recovery is, how strong the labour market is tomorrow. Because obviously the UK economic recovery has been fairly strong, and it does support a stronger pound. Okay, let's take a quick look at gold. Gold's been under pressure, actually. A couple of reasons. Number one, we've seen a bit of a truce. Well, not really a truce, but an alternative to military action show up in in Syria, and gold is a real safe haven. So if there is no Syria outbreak, then that reduces risks in that region. And we are right now, we traded as low as kind of just below 1360, but 1358 is the 100-day moving average, and that is capping the downside right now. We've currently not been able the last couple of days to get above 1400. Now, as you can see, the range is really narrowed. You can even see that by just these candles. The candlesticks are quite narrow. They're not, we're not getting these long, stonking, great big candles like we've seen in gold in the past, which suggests that we're not in a type of trend at the moment. This 1400 level, and then of course here, kind of at the 1430 level, is capping the upside for now. And right now, it doesn't look like we've got too much in terms of direction. We haven't even got too many directional drivers. Obviously, next week tapering will be important. So if the Fed does taper, and they taper maybe less than expected, that could be gold positive. If they don't taper, or if they do taper, and they taper, say, 20 billion plus, that could be gold negative, because it would be a larger taper than some expected. Rocco, you've asked a question. I will go back and answer some of the other questions, Ray and Ty. But you've just said, if the 10 billion taper in September, are we on the right level, euro dollar, or more like 131 level possible? I would say, if anything, if they do about 10 billion, then I say that we are about on the right level, because that's what's being priced in now. So if they do what the market expects, then the market reaction will be less. If they do more, so if they did something more like 50 or more like 20 billion, then actually that could be what pushes us below 131, maybe towards that 130.80 level, which is the key technical support level as well in euro dollar. But until then, this is important for gold as well. It's all about waiting for tapering. And as I said, that 1360, and then below there 1332, which is the 50-day moving average here, with 1440 on the upside, really capping the upside there. So I see trading in a range. Sorry, it's not more interesting for gold. Now, Ray, you wanted silver. I'm just going to look at silver spot, if that's right, Ray. As you can see here, silver spot moving in exactly the same direction as gold. It's also waiting for SEP taper, or waiting for, the Fed's tapering program to begin or not to begin, as the case may be. You can pretty much see the range, right? Just below 25, 24.75 on the upside. And then on the downside, we have got this kind of low here, which comes in at 23. And if we get kind of further downside than 22.65, which is the low from 21st of August. So a few weeks ago now. Rafiq, you've made a good point. Should oil drop is oil dropping due to kind of the changes in the situation in Syria? Indeed it has. I just looked at Brent before I wasn't in yesterday, but just looked at Brent, before I joined this webinar, just to see what it had done. And as you can see, signs that there's going to be some sort of diplomatic resolution to the Syria crisis, or at least to US involvement in the Syria crisis, has really pushed us lower again. So we're still within our trading range. The market isn't fully willing to give up the gauntlet on oil yet. And if there were an escalation in tensions, maybe, this non-military intervention falls through or something, then I could easily see us back to these highs of 117. But for now, the low looks like it's kind of 113 on the downside. Remember, Obama is speaking later today. That's going to be important because he's going to address the nation specifically about Syria. So again, if he sounds hawkish or sounds like, he still wants to invade, then we could see us go higher. But if he just reinforces the fact that that the US is not going to kind of go down the military route, then we could retreat back to our prior trading range between kind of 112 on the upside and kind of 106.70 on the downside. So that where that 106.60, which is that 100-day moving average. So we could just retreat, just drop back. Is no military action dollar negative? Well, some people have argued that, but I actually think that no military action is possibly more dollar neutral. Actually, there is no real evidence to say that any military action that the US has taken in the Middle East over the last 20 years has really had a sustained or a unified, or there's any kind of unifying theme regarding the dollar. It tends to move in its prevailing trend. So let's just go back to the dollar index here, just so I can show you that. And as you can see, the dollar's trend there isn't really one. I would say that, in my view, I think no military action is a dollar negative. I actually think it may be slightly more dollar positive, actually, because no military action actually supports the Fed starting to taper this month. If there was military action, the risks associated with that could mean that the Fed have thought them to be too large to also start tapering in the same month. So that's my 2 cents on it, Steve. So I would say it's slightly dollar positive actually, because it supports it does actually support them starting to taper straight away. Ty, you've waited really, really patiently about Kiwi. And Kiwi is interesting. Did you say, oh, sorry, you said Kiwi yen. Let's take a quick look at Kiwi dollar, because I just want to show you this nice recovery that it's having. It got above the 100-day moving average earlier today at 80.10. And we're getting close to kind of the top of its near-term range, which comes in around about 81. So we're only about 50, 60 pips away from there now. So that's the backdrop. That's the overall backdrop. Here with Kiwi yen, as you can see, another nice strong day. Oh, you can't see it yet. Another nice strong day. Got above that 100-day moving average. Came in at 79.30. We're now above 80, so we're above the top of the weekly range. Now, partly that is because of what the Aussie is doing, but it's also because the yen has been very, very weak. I looked at the yen earlier. Did I? I think I did. Maybe I spoke about it anyway. But the dollar yen got above 100 today. The yen was weak because of some expectation there could be more monetary stimulus if the government go ahead and raise their sales tax as they're expected to do. By the way, even some of you who may not have heard too much about the sales tax in Japan, what we have to see is, in October there could be a lot more talk about it. So just keep your mind out. Don't worry too much about what it is, just raising a sales tax. They're worried that will have a negative impact on the economy. So the government is saying, well, we want an economic stimulus package to go alongside this sales tax. So, and that's weighing on the yen, and that's what's helped pushing up the yen crosses across the board. So above here, we're looking at this high here, which is just around 81. And then we're really kind of on our way, actually, back towards this kind of 83, 84 level. So we've broken out of it looks like we've broken out of our trading range. I'm going to wait for today. I'm going to wait for tomorrow. To see if we can extend that. But probably any move back towards kind of 80, 10 will could potentially be used as buying opportunity. And then Rafiq, last question here. With world markets going up, are they sustainable? Indeed, stock markets have been going up. So quick look at the SPX. They're sustainable as long as the economic data is good. And the economic data in the US has been remarkably mixed, I would argue. So that's one of the reasons why. But the fact that we're kind of back crossing this 50-day moving average, downside is limited, I would say. Is it sustainable? I think it's sustainable, certainly in the short term, as the economic data does look like it's quite strong. Okay, everyone, thank you so much for joining. It was great to have you be so interactive as always. Please do join us next week for more, and good luck trading this week. As I said, check out our page and our research page. It's always good to get you guys reading more of our research. And always, we're open to feedback. So you can give me feedback when you come to this class, when you come to this webinar, or elsewhere. So great. Thank you so much, everybody. I hope you found that useful, and great. Thank you.